It was another risk-off week last week with the S&P 500 notching its worst week since October amid ongoing jitters over valuations in the AI space, though a bit of a dovish repricing of Fed policy expectations did help spur a round of dip buying on Friday and also allow sentiment to start the new trading week on the front foot too, with treasuries also rallying at the front end of the curve, while the dollar has found a little bit of demand and actually notched its first weekly close north of the 100 figure since May at the back end of last week. Turning to the week ahead, focus is going to fall on even more delayed data releases out of the United States, while we have the budget to get our teeth into here in the UK. Although remember, of course, Thanksgiving will interrupt proceedings on Thursday and Friday, so we are dealing with a holiday-shortened week ahead. In any case, plenty for us to discuss on the trade-off this week, so without further ado, let's crack on with the show. So plenty going on in financial markets last week, and although this week is shorter, there is likely to be plenty going on this week as well. Joining me to make sense of everything that's going on is my good friend Ryan Littlestone from Forex Relied and Forex Analytics. Ryan, a very good afternoon to you after a brilliant sporting weekend. England doing the clean sweep in the autumn internationals, Arsenal proving that North London remains red, and how did West Ham get on?
We got a draw. We managed to scrape a draw.
Well, that's akin to a win for you lot these days, isn't it?
I'll take anything I can get at the moment. I'm surprised we got out of there without needing to swim home. The weather was so bad.
Well, I think a lot of market participants are thinking they had a bit of a lucky escape after last week as well. Some incredibly choppy trading conditions. Obviously, we had Nvidia's earnings on Wednesday. We then had that big reversal in risk on Thursday on an intraday basis, and then a reversal of the reversal on Friday after those dovish comments from New York Fed President Williams. I don't know about you, but I've spent most of the last week not knowing whether I'm coming or going.
No, I think the market's exactly that way as well. And as you mentioned, it's a shortened week with the Americans practice Christmas. They get two shots at that. They get Thanksgiving and then they get the actual Christmas. I'm surprised you're even here because isn't this the start of your 2 months of lunches?
I knew this was coming. It's not 2 months, it's 3 weeks. And I have said for a long time, and I'm glad you've brought Thanksgiving up, that this week is basically the last proper trading week of the year. And actually, and on a slightly more serious note, I do think quite a few market participants who will have come through the last 2 weeks, certainly stateside, it's been a very tiring, very exhausting, very battering and bruising past couple of weeks. I think a lot of people will actually, in all seriousness, be going, do I really want to come back into December, which could be very, very choppy indeed. We don't know what the Fed are going to be doing in December. We don't know what the fallout from the budget's going to be. Risks of yen intervention, which we're going to discuss, geopolitical shenanigans ongoing. It doesn't feel like it's going to be that sort of cruise into year end that we often expect.
No, and you're going to miss most of it. So it'll be down to me to fly the flag for us analysts and traders over here in the UK.
Well, that would be a first. Why don't you start flying that flag then in Topical Thunder? Well, this was meant to be my topic, but sounds like Ryan's going to do it all, and I'll go and have a pint somewhere if that's how we're going to work this. No, in all seriousness, I will. Duty called, so I will hang around. Of course, we had the latest non-farm payrolls numbers out of the States on Friday. It didn't really feel like a non-farm payrolls day, though, I must be honest. It was a Thursday, not a Friday, and someone was too lazy to organise a sweepstake as well, so we didn't even have any fun around the figures. Now, the September data is obviously very, very stale, and I think it was a bit of a mixed bag. But the way I'd be looking at US economic data at this point is basically through the lens of, is it bad enough to force the Fed's hawks to change their minds? And I would argue that the jobs data we got on Friday, although it wasn't great, probably isn't bad enough to force those hawks into changing their minds just yet. In terms of the key figures, headline payrolls rose by 119,000 in the month of September, well above the top end of the forecast range. But we did have a sizable net downward revision to the prior 2 months worth of data to the tune of 33,000, which means the economy actually now shed jobs in August based on that revision. And when you dig into the composition of those job gains, they were pretty much all in healthcare and in hospitality, which is potentially not a great sign because it implies that the job gains are not necessarily especially durable and certainly not particularly widespread across the economy. In terms of earnings pressures remain very, very well contained indeed, rising 0.2% on the month, 3.8% on the year. There's no real inflation risk there. But in the household survey, again, a little bit of some question marks being raised. Unemployment rose to 4.4%, up from a prior 4.3%, especially for Ryan to 3 decimal places. Unemployment was at 4.440%. So very, very, very close to getting up to that 4.5% mark. And if you get a headline print of 4.5%, it's a very different reaction to the one we had on Friday. But in many ways, that rise in unemployment was a good increase, as perverse as that sounds, because it came on a rise in labour force participation. So more people coming in and looking for jobs, as opposed to unemployment rising because layoffs have increased. So that's an important caveat to remember. And I think the report just emphasises that the US labour market is still a bit stuck. We're still in this kind of mode where businesses aren't really hiring, but they're not really firing at this moment in time either. And what that means for the December FOMC, which of course is in a little over 2 weeks' time, I think frankly is anyone's guess without wanting to sit on the fence too much. If you look at what individual FOMC members have said over the last month or so, they are almost perfectly split between about half the committee who seem to favour standing pat and the other half of the committee who seem to favour delivering another rate cut. And one of that half, of course, is New York Fed President John Williams, who noted on Friday that he still sees room for a rate cut in the short term. And the market is kind of viewing Williams as a proxy for Fed Chair Powell. And basically the maths is if Williams wants a cut, then Powell will probably want a cut as well. And if Powell votes in favour of a cut, the expectation is he can bring some of the other swing voters, people like Governor Cook, Chicago Fed President Goolsbee, etc., with him in that decision to lower rates. Now, we do have 1 week left to go until the blackout period. We've already heard from Fed Governor Chris Waller this week, earlier on today. No other Fed speakers are due this week, so we are going into the blackout period a little bit in the dark in terms of what the Fed are going to do in December. The direction of travel remains towards a more neutral policy setting, but are we going to get that December cut, do you think, Ryan?
That's a good question. Like you said at the top of the show, the market's been all over the place. I mean, we came into last week sort of 50-50 in the rate probabilities. Then with some of the Fed members saying, we should stay on hold, it swung a bit to the staying on hold side, and then we had Williams coming out. It swung back the other way, and now we're pretty much pricing or leaning towards the cut side. It's all going to be really messy. The big thing is that all the new data or the upcoming data is going to be after that Fed meeting. Why they decided they couldn't get that data out before the Fed meeting, Powell must be doing his nut over there. But that's going to create a lot of volatility because we're not getting any jobs numbers or any CPI data before the December meeting. Are we going to get a cut? I'm in the same camp. I think it's 50-50. I think there is probably enough reason for them to pull another cut out the hat and then sit on their hands maybe into the new year and see what happens. But none of the data that we've seen since then, PMI data, we had the flash numbers on Friday, no problems there. Some of the other data that's been dropping, no real problems there. So, I saw that NFP data on Friday, and I thought, well, this looks like good numbers. I mean, I was keeping an eye on the private payrolls, as I mentioned, because that, if we were going to get a government skew, but government jobs are up 22,000. I think privates came up 97,000. So, yeah, we're still in the double digits rather than the triple digits, but it was still good data. It's still adding jobs. And I did ask the question on Twitter on Friday, if the Fed had that September jobs report before the October FOMC, would they have cut rates knowing that jobs had gained 119,000? And it was a bit of a split decision, but people were saying no, they wouldn't. So I wanted to know your thoughts on that.
I didn't see you ask that question. So that is a really interesting one because, of course, the data was due at the start of October, so they should have had that by the time of the meeting. I think they probably would still have cut. I think you'd have had more dissent, though, because obviously you had Jeffrey Schmid, the Kansas City president, voting in favour of standing pat at the end of October. I think you probably have had almost the situation you've got with the FOMC now, where you've got people like Musalem, Goolsbee, Collins casting doubt on whether you need to cut rates more, Governor Barr as well. You would almost have that, but this time last month, if that makes sense. So you would have the same split on the committee, but just a month earlier than we've actually ended up getting it. So
Yeah.
I think they would have pushed through a cut, but rather than a 12-1 vote or it's technically 1-10-1 vote because Miran dissented the other way, but you would have ended up with more of those hawks preferring to stand pat, I think.
Yeah, that's a reasonable point, and sort of the same sort of thinking that I had. But yeah, I mean, moving forward, we're going to be looking ahead to that December meeting. I think there is a big danger of a lot of volatility, price volatility. If we're going into that meeting 50-50 in expectations, then that leaves us a binary, price risk either side if they hold or if they cut, and then the data 2 days later could completely 180 whatever they've said at that meeting. If they think, yes, we cut rates because things are looking a bit soft still, and we get a 200,000 NFP and not affected by all those government jobs, then everyone's going to go, whoa, they've cut rates and they should have stayed on hold. Conversely, if the numbers are bad and they've gone on hold in December, the market's going to throw a bit of a dovish paddy. So, lots of volatility that week, and shame we won't be here.
I will be here. Stop it. Well, at least be here for the Fed meeting. I've got a few other bits and bobs to do that week. Anyway, moving on from that, speaking of volatility, because that could get very spicy, what is getting a bit spicy at this moment in time is where the yen is trading, because it seems like almost by the day, the Ministry of Finance are sort of upping the ante in terms of their jawboning on that front.
Yeah, exactly. Last week I was warning about the intervention playbook and how that might have changed with this new government. And we were closing in on the level in the BOJ's yen index where they intervened last July. But news since late last week may have turned the yen ship around, or at least made further big weakness a little harder to achieve. We got the confirmation from Takeichi and the size of her fiscal package, 21.3 trillion yen, which is $135 billion. This was about in the middle of
money.
Is what, sorry?
I was going to say, it's about a fiver in proper money, isn't it?
Well, it's not as much as Germany's 500 billion, which begs the question: why is the market getting so antsy over Japan? A piddly 135 billion compared to Germany. But there you go. That's for another topic, another day. So that number 21.3 trillion was round about in the middle of various sources, pieces, trying to guess what the number was going to be. Probably a little to the low side. Some were looking for 25, maybe even 30 trillion. So 21.3 wasn't too bad. Now we've had that number out there. There's no more, trading the guess and how fiscally dovish she's going to be. Secondly, we had the CPI data, national CPI data, which showed inflation sticking around that 3% mark. So that was good news for Japan as well. And then thirdly, we've had Governor Ueda coming out with some comments, and he was leaning slightly more hawkish, which has led to higher rate hike expectations going into their December meeting. We've had a couple of Fed members, one late on Friday, Masu, who also saying we are getting closer to a hike. So all of this has managed to put a bit of a bid in dollar yen, and that saw yen pairs in general coming off from their recent highs that we got last Thursday. Now, I'm not definitely saying that this is a top when we're going to drop 1,000 pips from here, but there is a good chance that if we get positive wages news, if we get better economic data, inflation holds up, as well as this spending package, bearing some fruit, we could at least mean that we enter a period where yen pairs are rather a rally sell than a dip buy, as they have been recently. So for dollar yen, looking at the chart, we have broken back below that 157 level, and it held immediately after, and even through today, it's currently holding. The next big level will be down at 155, and breaking below there will add some extra confirmation that maybe the sentiment has changed, and whether that's short term or otherwise, that we could be looking for a bit of a yen buying spree. Now, obviously, a quick return back above that 157 and through last week's highs would invalidate that thinking altogether. So, as always, let the price action be your guide.
Yeah, absolutely. It's interesting how the narrative has changed quite dramatically on that front since we discussed this last week. It does seem, I think either on the show or in a note last week, I sort of referred to this as the admin trying to sort of have their cake and eat it by running this ultra loose fiscal policy and trying to keep monetary policy very, very easy as well. It seems like that ultra loose fiscal policy is not necessarily as loose as it could well have been. And to your point, the important fact is we now have some certainty on that front. front. And there also appears to be less aggressive sort of leaning against the BOJ in terms of trying to deter them from raising rates. Now, we do still have a fair way to run until the December BOJ meeting. I don't think that comes, is it the 18th or the 19th of the month? It's towards the back end, isn't it? So we are likely to get plenty of sources stories in the run up to that. But you're absolutely right. It does feel potentially as if we sort of reached a little bit of an extreme in terms of sentiment and in terms of positioning last week, and we're just coming back to a little bit more of an equilibrium now, certainly when you look at the dovish repricing of Fed expectations in the mix as well.
Yeah, absolutely. I'm just keeping an eye on the price now. We're just having a little move back above that 157 level. But then, we might
forget everything I just said.
Yeah, might as well cancel this.
Then trade 160, and then the MOF are going to come and smash it down 5 big figures. There you go.
Yeah. The interesting thing to note is that obviously there's been a lot of focus on the inside of things. So obviously what's going on elsewhere in the US in particular is going to have an effect on what's happening in dollar yen, also what's happening in Europe and euro yen and with the budget and pound yen. So it just might mean that the focus shifts more away from the yen side of things to what everyone else is doing. So yeah, we could still rally up in dollar yen, but it might be because we're getting super good data or the Fed go on hold or something like that. So yeah, it's all about knowing what the drivers are behind any currency pair, because you've got to remember there's always two sides to them.
Yes, absolutely. Right. In terms of changing focus, let's do it. Viewers have a nervous disposition. I would advise you to just turn off the rest of the show, to be honest with you, because it certainly ain't going to be cheerful. We are finally here after 3 months of uncertainty and trial balloons and leaks and rumours. Oh, and an emergency press conference, of course, as well. The budget is finally upon us. Chancellor Rachel Reeves will stand up in the Commons about 12:30 London time on Wednesday to deliver, well, goodness only knows what in terms of precise policies, but what we are definitely going to see is a significant fiscal tightening. Before getting onto that, it is just worth mentioning that, of course, that uncertainty that I just alluded to has had an absolutely huge economic impact. If you look at some of the data we had out last week, retail sales fell in October for the first time since May, and we also had a 7-month low in the services PMI and the GfK consumer confidence metric that fell not only at the headline level, but on all 5 of the sub-indices as well. So this business of sort of doing leaks and rumours and all the rest of it has not done the economy any good whatsoever. Anyway, the budget, what are we going to get? We're probably going to get somewhere between 30 and 35 billion pounds worth of fiscal tightening. Pretty much all of that is going to come via tax hikes, given the government's unwillingness / inability to deliver spending cuts. And when you add that to the OBR's latest projections, that is likely going to yield between 15 and 20 billion pounds worth of headroom against the fiscal rules, which, while still less than the pre-COVID average of about 30 billion, is going to be about double what Rachel Reeves left herself in the spring. We are pretty sure that we will not be getting a hike to income tax rates. The government had trailed that very extensively. Then they U-turned and said that wasn't happening anymore. It seems unlikely that they're going to do a U-turn on the U-turn. So instead, we're going to get what's being dubbed a smorgasbord approach to tax hikes instead, which is essentially lots of very small tax hikes, which add up to about 30 billion. There is far too much going on that front to run through it all now. And of course, this could all change in the run up to the budget itself. But one of a number of the key measures that are likely to be on the way include freezing of the income tax thresholds, uprating of council tax, particularly on the largest properties, potentially increases to the banking and gambling levies, as well as an electric vehicle tax. They have all been strongly rumoured in the press. There are also likely to be spending increases. In fact, as a result of the budget and the welfare U-turn in the summer, the government are probably going to be spending about 10 billion quid more than they were forecast to in the spring. And one of the big contributors to that, of course, is going to be the lifting of the 2-child benefit cap that is almost certain to come on Wednesday. We always ask when we're leading up to a budget, is the Chancellor going to have any rabbits in the hat? I doubt it, to be honest with you. I'm not sure we can afford a rabbit this year, let alone affording a hat to pull it out of, if I'm being completely honest with you. But I think for financial markets, there are going to be three focuses as we move through the budget. The first is going to be, does this balance the books and are the fiscal rules met? And I don't just mean on paper by backloading a load of spending cuts that we all know aren't going to happen. I mean, in reality, is there a chance that this does really steady the fiscal ship here in the UK? The second thing is, what's the gilt remit going to be in terms of the year ahead? How much does the government think it's going to need to borrow from financial markets over the next financial year? And also, how is that going to be split across the curve? Is it going to be tilted towards the front end as we've seen in recent years? And thirdly, and potentially the most important and certainly a longer run consideration, is what does the political fallout from all of this look like? I think it's going to be very unlikely that much of the electorate is pleased by what the budget delivers. I certainly don't think markets are going to be particularly happy. But what does the Labour Party think of it? And do the Parliamentary Labour Party view the budget as the moment to strike, so to speak, and look to potentially remove Starmer and or Reeves in the aftermath of Wednesday lunchtime? So very, very busy week ahead here in the UK, and one where, sadly, I think good news will probably be in short supply.
Well, I'm gonna slightly beg to differ on that front, because we have heard this morning from one of the Sky political correspondents, Sam Coates, that the OBR might have indicated, or the Treasury might be indicating, that they're going to have bigger headroom than what they expected. So that would be a bit of a surprise, but it'd be a surprise in one aspect, not in another, because they sent out these trial balloons saying it's going to be much, much worse. So if it's not as bad, they're going to claim that as a win. The market's a funny one. All through this, we've looked at it from the perspective, the market wants to know, can she achieve this headroom? And is it going to be easy to do so? They were happy with the income tax hike because that meant it was a big ticket item, if you like. It was going to bring in lots of money, and thus she's going to achieve it. Now she's going for all these smaller smorgasbord measures, and that's a bit up in the air whether that's going to bring in the money that she needs to. So in one sense, the market, if we do get that bigger headroom, then the market's going to be calmed by that. If it's achievable, then I think we're going to see the market pretty happy. But like you say, what happens after that? Are we going to see the economy recovering? Who knows? It's doubtful. But this whole budget has also been about the financial side. It's been about party politics. One of the big reasons why she caned that or binned that income tax rise was because of her own members in her party pushing back and saying, well, we had that in a manifesto pledge not to raise taxes on working people, and you're going to go ahead and do that. And that's why she reversed that. So there is a lot of party politics to play. I think this budget at the moment is looking like she's tried to walk the middle line between what she needs to do and keeping her own party happy. But like you say, what the result is, we'll find out on Wednesday afternoon.
Indeed. I'll ask you the question that our good mutual friend Michael Hewson asked me last week. Well, he is our good mutual friend now. I've remembered to invite him to some drinks. Is this Rachel Reeves' last budget as Chancellor?
Oh, that is a question. That is a question. You can never say never in politics. I'm 50-50. And I'm 50-50 because
what we love about you is your decisive nature, mate. You never try and sit on the fence at all.
She shouldn't have been in a job in the first place. That we all agree on. And I guess my reticence is that if she does go, who's going to come in? And whoever likely comes in is going to be twice as worse. So it's a bit of, I don't want her to go. Better the devil you know, I think. But that's a pretty poor situation to be in when you don't even want the person who's there at the moment. And you don't even want them replaced. So, yeah, I'm going to sit on the fence, mate.
Well, there we go.
What did you say?
Sorry?
What did you say?
Well, my answer is yes, I think it is. But then I did think that last year as well. So I'm not sure whether I'm talking more in hope than expectation at this point. But there we go. Right, there's the fundamental side of the budget. Ryan, how do we trade it?
Yeah, this is what we're going to need to do for us traders, is look at how to trade it. So I'm going to focus on two assets for this budget. Firstly is gilts, which is pretty much a proxy for the second one I'm going to talk about, which is obviously the pound. Now, effectively, we can use Japan as a blueprint for what the market reaction may be for the UK. Over there, the market was nervous about the size of Takeuchi's plan, and now we've had it, and It's not really toppy. The Japanese yields have come down a chunk and the yen has gained. And it looks like, as I mentioned, the same could happen here in the UK if Reeves confirms that the fiscal headroom isn't as big as feared and she's going to be able to get that money in. We're going to see a bit of sell rumour buy fact as far as the gilt market and the pound goes. Now, the press likes to focus on the 30-year UK 30-year gilt yield. So that's what I'm looking at. Now, despite the more positive vibes over the last few days, yields haven't come off much, and we haven't even come close to closing that gap we saw when she did the income tax 180. So there's still some uncertainty in prices. And if the market likes the budget, we should see these yields moving back down to, 512, maybe the low fives area. If the market doesn't like it, we're going to be heading back towards those highs at least. So a drop in yields will be good for the pound. And as I've been short the pound against the euro since July, just for this very event, I expect to see this pulling back also, euro sterling pulling back also. It's possible we see a move maybe down to 87.50, 87.20, maybe even further down to the figure. Now, if it's a negative review of the budget, then we could be up and breaking the 89 level pretty quickly. So overall, even once past this budget, the fact remains that the UK economy isn't strong and the budget is not going to spur growth. So even if markets like all the fiscal headroom, the financials this week, it will still have to do with broader economic weakness down the line in the longer term. And that could limit gains in gilts and the pound and maybe even reverse them soon after. So while I'll probably look to reduce my euro sterling position, my longs ahead of Wednesday, I'll still stay long and I will be adding on any dips to play the longer game in that UK weakness.
Yeah, and excuse me, I think that's the really important thing is that, we're all talking about the budget and it's effectively government by spreadsheet. Again, how do we get to 10 billion? How do we get to 15 billion? How do we get to 20 billion in terms of headroom? Everything that's been trailed has either been, how do I put this in a politically correct manner? We're going to tax productivity more, whether that be in terms of workers or consumption or businesses, and we're going to give away more to the unproductive, and hopefully I don't get cancelled for saying that, but in terms of welfare spending and things like that, there's nothing where, and maybe Rachel Reeves proves me wrong, and maybe there are some growth enhancing measures in the budget, and I hope to God that there are, because we damn well need them here in the UK at this point. But if you look at all of the leaks and all of the rumours, there's nothing there that you can point to that goes, that's going to spur investment, that's going to spur capital spending from businesses, that's going to spur job creation. Actually quite the opposite. And that economic weakness is something that I think the market has almost glossed over with this laser-like focus on, are the books balanced, and not really concerning themselves, even though they should be, with what the longer term economic story of the UK economy is, which is one where the OBR, and pretty much they're just catching up to everyone else in downgrading their productivity forecasts, but they're also likely to downgrade their GDP growth forecast as well. So I think that's a really important point, and that is going to pose structural headwinds for the pound, certainly if it leads to a more dovish policy response from the Bank of England, as is very likely, with a rate cut in December on the cards. And I think just lastly, I would say in terms of gilts, one of the things, if not the thing I'm going to be watching most closely over the budget is not only where gilts go in isolation, but the spread on gilt yields over G7 peers, particularly in terms of treasuries, because that is what you can use as basically a proxy for how much political risk and how much fiscal risk the market is pricing when it comes to the UK. At one point towards the back end of the summer, the 10-year gilt yield was trading at about a 60 basis point premium over the 10-year treasury yield. That came down to about 30 basis points, just under 30 basis points in mid-October. I think round about now, we're trading at about 40, 45 basis points, so in the middle of that range. And I think that spread is going to be the key thing personally in terms of gauging whether this has gone down well or badly with financial markets. Although sadly, because the Treasury only have 11 Bloomberg terminals, they'll probably find out in a week's time when they read The Economist or something.
Or they could just listen to our flow show, to our trade-off next week, and they'll find out exactly what's happened. So, you may have to key them in. And meanwhile, we'll get the budget and I'll have to decide whether I'm going to knock down a conservatory to get under that council tax ban that they're going to hike up.
Well, wasn't there one, I can't remember whether it was Italy or Greece, probably both, where they were just sticking scaffolding on their roofs to claim that houses were under construction and get out of tax that way. I mean, we'll end up doing all sorts. We'll have a conservatory that's actually a shed for tax purposes or something ridiculous. Right?
I wouldn't be surprised they brought out the old window tax and we'll have to brick up our windows like they did in the old days.
Oh, mate, don't give them ideas. Don't give them ideas. Right, before Ryan sends any more leaks down to the Treasury, let's get on to our plays of the day. Right, I'm going to be looking at FX volatility this week. Of course, we do have effectively 4 weeks left of the trading year, although according to some, we only have about 3 days left. But having said that, there are a lot of unknowns as we move into the back end of November and also into December as well. Of course, we've mentioned the December Fed meeting, which is basically a coin flip at this point, no matter how markets price it. We don't know how the budget's going to go down, whether there'll be intervention in the yen, various geopolitical issues going on with the Russia-Ukraine talks continuing. Also, the equity market, is sentiment going to continue souring, or do we get that Santa rally that so many people are hoping for, including myself, I would add, and many more besides. But against all of that, if you look at volatility, certainly in the FX space, it still seems a little bit too subdued to me, to be completely honest with you. 1 week and 1 month G10 implieds remain within the bottom 20th percentile of their 52-week ranges. And if you look at JP Morgan's G7 FX volatility index, which I have on the screen here, that is, as near as makes no difference, where it was this time last summer. And I don't think anyone can describe last summer as a volatile time for financial markets. We are also well below the 12-month average, which is about 8.3, and we trade at 7.2 at the moment. So the question really, in terms of a risk-reward basis, is can vol get cheaper? Well, yes, it can, but I'm not sure it can get that much cheaper, given a look at this chart. Can vol ramp up into year-end? Well, I would say the balance of risks absolutely tilts that way at this moment in time. So FX vol is potentially something to look at as we move into year-end. Ryan, you are going into the world of defence stocks, of all things.
Yeah, absolutely. Going off the beaten path for once. I'm looking at potentially what's going to come next if we get some good news from Ukraine, Russia. Now, first and foremost, let's hope that there's going to be a peaceful solution. It's what we all want, and if we get that, then that should be celebrated. But the initial market reaction to a confirmed end of hostilities is likely to see European risk, shall we say, getting a boost, and maybe even the euro. Now, I think we've already seen a bit of a shift out of defence stocks since we've had this news coming out that we've got a deal on the table. And I can see further profit taking coming from that sector if a deal is confirmed. Now, what interests me is what comes after. If the deal on the table is to be believed, then peace will come at a pretty hefty cost for Ukraine, and any dips in defence stocks are likely to be bought up, in my opinion. Ukraine will still need to replenish their arms inventories. Europe will be doing the same, and remember, they've earmarked billions to do that and spend on defence over the next 10 years or whatever. So that money isn't disappearing soon, and the need for defence armaments and the like is not going to go away. So none of that is going to go away with a deal, a peace agreement, if we get that maybe this week or in the next couple of weeks. So I've picked Rheinmetall as one asset, one stock that might see a decent dip on a peace deal and then get bought back up when the dust settles. It's had a very strong rally, and a pretty late one considering when this part of the war kicked off. So I think dips anywhere near the 50 retracement, or even down to the 61.8 fib of the November 2024 swing up, will be good places for me to maybe start building a bit of a long position for maybe a longer term play.
Very good. And I think that point you made earlier on is really important, that, peace deal or not, and obviously we hope that a durable and long-lasting peace is able to be achieved. The order book is not going to be dying down any time soon for either Rheinmetall or any of these other defence names. So, I think most of the market are very, very bullish on the sector moving into 2026, which probably makes you rather nervous now I've said that. Anyway, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex So Live. Live, and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts on what we've discussed, how you're trading the markets, and if there's anything you'd like us to touch on this time next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead. Thanks for watching, and goodbye for now.